Hey, good morning, everyone, and welcome to the second edition of the series on stage analysis. This one is going to cover the Stage One Accumulation, and like I said, this is the second video in the series explaining Stan Weinstein's market cycle theory. So, going on, how to identify Stage One accumulations. So, in most cases, your Stage One accumulation will follow a Stage 4 decline. Stage 1s form after a selling climax, meaning bears have lost the momentum. So Stage 1s are often formed during moments of pure fear. Market participants are underwater and the smart money has been in cash or selling short for a considerable amount of time. You will know Stage 1 is forming when a selling climax has taken place. This climax usually occurs on heavy volume and sets the anchor point for the Stage 1. So, the bears have now lost their momentum, but sentiment will often be abysmal at the start of a Stage 1. So, the market has soured on that particular asset that we're looking at and doing our stage analysis on, and for good reason. It's often gone down 30, 40, maybe even 60 or 70%, and no one is wanting to buy it just because they're fearful that they're going to be catching a falling knife. They're fearful that the asset may never recover ever again. And this is the type of sentiment where market bottoms are formed. So moving on, here is the chart. So here is where your Stage 3 forms up in this top, and then this downtrend area, that's your Stage 4 decline. And then here we are, this is what we're talking about today. This is the Stage 1 accumulation. Here's your 20-week moving average, and we'll kind of go into some more things next. So, supply, also known as resistance, is where you will find willing sellers / short sellers. So let's go back to our chart. So in our Stage 1, here is our resistance zone. Resistance is overhead, so that's where that supply is going to come in. That's where price is likely to fall back. Demand, also known as support, is where you will find willing buyers / short sellers covering. So down here you can see our support area. That is where price will stop dropping and start to either go sideways or go up. And then the anchor point of a Stage 1 is the first sign that demand is stronger than supply. Price has fallen to a level that interests institutions and other big money. So your anchor point is the first area that the support is formed off of. So we have this huge Stage 4 decline coming down. Nothing holds here, bam. This one gets a big move up, and then it holds, and then it comes back down, and it still holds, and it goes back up, and it's still higher. So this is a big-time anchor point for us. This is where we're going to kind of set our bias on this particular asset. If price is above our anchor point, then our bias is going to be that the Stage 1 is held. If price falls below that anchor point, our bias is going to go back towards price being in the Stage 4 decline. And then after rebounding off the anchor point, price will continue higher until it is met with resistance. So here's where our anchor point forms, and then price continues higher until it hits a resistance. So 3 reasons why resistance is a thing. So going back to our chart, traders who bought the anchor point are at a profit and selling into strength. So all of our bottom fishers, all the people that maybe just blindly bought this chart because they said, hey, it was at 30, now it's at 8, this must be a good buy. Maybe once in a blue moon you catch this and it works out well. So they went from 8 to 12, they're up 25%. That's a good move in this short amount of time. So they're going to be taking profits. That's where resistance is going to form. Another reason resistance forms, so trap traders who bought at much higher are selling at a break-even / percentage loss of their position. So going back on this chart, so let's say, your buddy bought at 11, it fell to 8, and then it went up to 12. He's just happy that he didn't have to sell at that loss, so he's getting out as soon as he can. There's also that person that bought at 20, and they want to go down, all the way to 8. and then they finally get a bigger move up to 12, and they're like, I got to get out of this thing. I'm going to take the loss. It doesn't even matter anymore. I cannot be in this asset. And then finally, you have short sellers that are re-entering their position in anticipation of price continuing its decline. So last time here, so our short sellers got this big move down, possibly they bought this pullback that started the stage 4 decline, and they had this huge profit. Price went all the way from 24 to 8. So they're just ecstatic about this. And then they start to cover at the support area, and then they find that this might be a decent place to re-enter their short position. So they start selling the asset, and then that's what creates the second down move here. And that's kind of how resistance works. And then how does supply work? So demand. So after being rejected at resistance, price will often fall back to the anchor point support level. So going back to our chart, here's our resistance, and this one gets pretty close to our anchor point support level. So 3 reasons why demand is spurred. So traders who sold short at resistance are buying to cover at profit. So much like our trader who bought this bottom and sold the top, there are traders that are going to catch the top and they sell the bottom, and they're going to sell the top and buy the bottom if you're a short seller. So that is what creates that demand upward. These people are buying to cover their shorts, so demand is being introduced into the asset. Next, you have trap sellers who bought much lower and are buying to cover at a break-even / a percentage loss of their position. So, maybe in this example, someone sold short at this $8 level, and then price immediately reversed back to this 12. They saw this big, loss once price went up, so they were just ecstatic to get it back to their break-even price, and they sold out as soon as they could because they did not want to be in this asset anymore. And then finally, you have buyers who are re-entering their position in anticipation of price reversing at the anchor point support level again. So maybe your smart money got out up here when price pulled back to the previous support, now turn resistance. Then we had this huge downtrend, and the whole time that smart money is either sitting in cash or they're shorting. And then they start to see that the support area is holding. So they're going to watch price go up, it's going to stop here, and then they're interested in buying this again because they believe this area is going to hold. And that's kind of some of the psychological reasons behind support and resistance. It's really just a way to determine, where market participants are willing to introduce demand or supply into the asset. Next part of a stage 1 accumulation. The most important part about a stage 1, it needs to flush out the weak hands and transfer that asset into stronger hands. So assets cannot increase in value until they are in a position of holders, until they are in possession of holders who are not going to sell at the first sign of a profit. So you need investors who are in it for an extended period of time, otherwise the asset will continue to be rejected at resistance. And then stage 1s are the visualization of assets being transferred from weak hands to strong hands. So by definition, a weak hand is often a trader. Weak hands will enter and exit an asset as quickly as possible. They will cut their position at first signs of a profit or loss. And then strong hands are often investors. Strong hands believe in the underlying fundamentals of an asset, and they're looking for longer-term price appreciation. So going back to our chart, so here is where, potentially your strong hands are buying. This is where your weak hands are getting out. This is where your strong hands are buying. This is where your weak hands are getting out. This is where weak hands got flushed out and strong hands took over. This is where weak hands are getting out, and then this is potentially where strong hands are getting in. And then finally, using moving averages to identify stage 1s. So coming out of a stage 4 decline, price will be below the 20-week moving average, and the 20-week moving average will have a negative slope. So here's our 20-week moving average. As you can see, during the stage 4 decline, price is way below the 20-week moving average. And that's kind of a way to signal that, we're in that stage 4 decline. It's simply just if price is below the 20-week, it's probably safe to assume that a stage 4 is taking place. and then negative slope. So as you can see, when we're in this stage 3, the slope of the moving average is more or less 0. The moving average is parallel to our x-axis down here. And then when we're in that stage 4 decline, you can see that the slope of the moving average is now negative. It's more or less parallel to our y-axis over here. So it has that negative slope. And the easiest way is just follow the slope of the moving average. If the moving average is down, then you're often in stage 4 decline. If the moving average is sideways, you're often in stage 1 accumulation. So after finding support at the anchor point, price will move above the moving average and be rejected at resistance. So in this case, our moving average was way above our resistance that's formed, but possibly think that price bounced up to this peak right here, and then we formed our resistance. So then next time we try to go for resistance, our price will be above the moving average, but we will still get rejected at resistance. And then price will oscillate above and below the moving average, and the moving average slope will gradually go to 0. So as you can see over here, price moves above it, the moving average starts to move towards a 0 slope. The slope starts to go sideways, and then price will often oscillate up and down in between that moving average. And in our chart examples, you'll see how that oscillation works much better. And then as the stage 1 progresses, the moving average will gain a positive slope. So that positive slope often signals that the stage 1 is coming to an end and a stage 2 breakout is around the corner. So here's kind of just, a life cycle of the stage 1, kind of summarizing everything we talked about. So after putting in the anchor point, there will often be a violent dead cat bounce, and this will look a lot better on the charts that we see. Volatility will be high at the beginning of stage 1, and in this sense, volatility means the percentage price increases based off the support and resistance zones, and that's something that'll be a lot easier to see on the charts. The middle portion of a stage 1 accumulation, so price will oscillate between support and resistance, crossing the 20-week moving average numerous times. That's that oscillation I was mentioning. And this is known as a whipsaw trading environment, and often volatility will be lessening in the middle. And then finally, at the end of the stage 1 accumulation, volatility has contracted significantly. Price gets above the 20-week moving average, and price is moving towards resistance. And then finally, to end the stage 1, price breaks out above the resistance, above the 20-week moving average, and that's what signals our stage 2 breakout. So now let's take a look at some charts. So here's ExxonMobil back from the 2020 COVID lows. So this, you could say this was a stage 4 decline anyway, but really once COVID kicked off, we got this huge acceleration to the downside. Here's our stage 4 decline. And then as I talked about, price is going to oscillate above and below that 20-week moving average. And as you can see, this stage 4 decline is still well in place because the slope of this moving average is pointing straight down. You cannot trust this candle here from June as a breakout because the moving average is pointing straight down. Everything is telling you all of the momentum is still to the downside. And as you can see, that volatility is huge. We get a price move from 30 all the way up to 55. That's almost a 100% move. That's huge volatility. And we just had price drop all the way from 68 to 30. That's a 50% decline. Just a lot going on here, something that you don't really want to be participating in because this volatility often shake you out just based on your stop losses. So price moves up here. This is now our resistance. We'll draw that point in, and then we come back down. Here's our anchor point. Like I said, this is where we're going to bias from now. This is where we believe that the bulls have kind of taken control. This is where the smart money is stepping in and saying that prices have been too low. This has been an irrational sell-off. So now they're looking to step in and set the anchor point. So that's what we got here around this $30 level. And then we go up to resistance, and then we come back down, and then we see, kind of just like in our example chart, price did not get all the way down to the anchor point, but it did kind of come into support, and then it moved back up. And then finally, throughout our stage 1, price gets back above that moving average, starts oscillating, oscillates down, oscillates up, and then the slope of the moving average goes sideways here. As we progress, the moving average continues up, and this is what I was talking about for volatility too. So we got that big move down, but then we did not see that huge move up that we saw previously. So here's our new resistance, and then that's where price is above both the moving average that's sloping up, and we get above our resistance, and that's your stage 2 breakout. So moving over to Souther Electric, same chart, period. This is from the COVID fall. So here's your anchor point, and then this is what I'm talking about, your volatility. So we get this huge down move, price runs back up to your negative sloping moving average, and then it just gets rejected. You know, we oscillate above and below, and eventually the sum of the declines and the sum of the rallies starts to lessen. So we get a big move down, we get a big move up, we get a smaller move down, a smaller move up, a smaller move down, a smaller move up, a smaller move down, and then finally this is where our moving average starts to go sideways, and then we see price break above that and our resistance here, and then we follow this one along. The moving average continues to gain upward slope, and then I'd say once we broke this 56 level, that was a pretty good indication that we were in this stage 2 breakout. Moving on to Spotify. So this was kind of an IPO base that formed. It IPO'd back in April of 18, and then it went through a stage 4 decline into December of 18, and then we get this good oscillation back and forth of this moving average. And as you can see, you know, this anchor point held well from this December low. We never really tested that level again. And here's your oscillation back and forth, moving average is sideways, and then we get our big stage 2 breakout here. You can see price breaks above this resistance level on this date. The moving average is pointing up, price is above the moving average. That's when our stage 2 breakout is confirmed. And then finally, last chart. So here's Boeing from COVID. Big stage 4 decline. We set our anchor point here around 88.50. Then we can't trust this breakout. The slope of the moving average is at a negative 45 degrees. And then we kind of just chop sideways for a while, you know, oscillating back and forth, above and below this moving average. And then we finally get our big break right here. We retest the breakout, and then it's off to the races, and your stage 2 is confirmed. So thanks everybody for, you know, attending the stage 1, and I look forward to seeing you on the stage 2 analysis. And thanks again.